ASML stock is right in the middle of the US-China chip war. Their machines are essential for the entire semiconductor industry, but geopolitics keep dragging on the company. Since July 2024, the share price has been sliding and it still hasn't returned to those highs. So the real question is ASML stock overpriced or is it a bargain? Let's get to it. Welcome to another video. My name is Robin, and as per usual, I am joined by Kirill, and we're back. We're back, baby.
Yes, it's been a while. Sorry, guys. We've been on vacation. Yeah, it's summer,
exactly. We needed it.
True.
Anyways, as you're used from us, we'll have our three segments that we'll dive into for our stock valuations. We'll go over what's in the news, the fundamentals of, in this case, ASML, and the valuation, so the stock price of ASML, and whether it's justifiable or whether it's a bargain or anything in between. And we'll guide you through it. Kirill, what's in the news?
Yeah, so pretty much there's not that many developments happening actually to the SML as a company and its stock, apart from the fact that it's just drifting sideways, mainly as you can see, and also from the article what we've seen a couple of days ago, it's actually pretty interesting because it says that currently ASML stock is valued like it was more than 5 years ago, which is pretty interesting considering the fact that it's one of the biggest monopolies on the lithography market. It's pretty much only one, apart from some rising alternatives in China, of course, due to geopolitical tensions and stuff like that. So maybe Robin can also shed a little bit more light on that.
Yeah, exactly. So, of course, one of the reasons why ASML has been drifting since 2024 is that they have as you mentioned, some kind of deal with the US that they are not allowed to sell advanced machinery to China. And this really limits their growth potential, especially in China where they would really want this technology. And hence it has been slowing down in the growth because of cautious outlooks and geopolitical risks. So investors really don't know what the outlook is for this company. So we thought, let's try to figure it out.
Yep.
It's a tough cookie to crack, but at least we'll go over, what you use from us, the fundamentals and stuff like that, so that you can get a clear picture.
Indeed, and it's also probably one of the bigger reasons why the stock is not climbing rather higher, is that China is actually trying to catch up on the lithography game quite quickly. So you could already see some of the news saying that some of the Chinese companies are really trying to make their first lithography machines already. Of course, you might consider it as a risk potentially, but on the other hand, seeing how the geopolitical environment is developing at the moment, I would be rather surprised that China would be supplying their machines, for example, to Europe or to US, for instance. It's mainly for their domestic use. However, on the other hand, for ASML, of course, it would be a big hit in terms of revenue, because then the local Chinese companies would rather switch to their counterparts from China as well, obviously. So it's pretty interesting to just discuss it, to see what kind of opportunities there are for SML there, for its stock, what kind of valuations we can get out of it. So is there anything else, Robin, you would like to say, or shall we get to it?
No, I'd say let's dive into it. Yeah. Let's go to the fundamentals of ASML.
Yes. There we go. There we are. So from the first sight, I'm pleasantly surprised by the PE ratio of 30. This is something kind of rare to see, especially in 2025, huh?
Exactly. Also, given it's high tech, as you mentioned, right? This is a machine that makes microchips. It's very difficult technology. There's no other company that can do these kinds of things. So you would think that they would offer a higher PE ratio at least, but no. So that's really good. It's good to see it's around 30 years. So I mean, it's average for the tech market, for big tech. So I think it's good.
Yeah, indeed. So it could be a potential grab even from the PE ratio perspective. And it's also accompanied by quite good gross and operating margins, which is
Yeah,
also very nice to see, even though it's a hardware focused company. It's not software.
true.
So
But I
also
can
good
also
stuff.
give you another insight into that as well. Because it's super difficult to work on these machines. If you buy something at ASML, it is more or less subscription based, where if you need the machine, you also get people to service the machine for you. So it's not as per se you go into like a store and be like, "Yo, I want to have this chip maker and install it, and I'll do my thing." No, it's you buy a package. It's basically like an F1 pit crew, or if you buy a high-end race car where you get the pit crew within the price of the car. It's the same for this. It's a more or less, like I said, not really subscription based. I'm not really sure. That's something for you to figure out how that model works, but that is how it works, and that's also, of course, something that they generate revenue on.
Yeah, cannot agree more. Only thing is maybe to add is that I even know that there are many use cases for the companies who cannot afford like the brand new lithography machine. They're even lining up for the refurbished ones. So they would
Mm-hmm.
even go to ISML just for their second-hand product, pretty much.
Yeah.
It's that in demand still, regardless of and other players in China trying to replicate the product. It's still gonna take them, first of all, a lot of time to even create something of a more or less of a stable product, and then get to the level of quality and precision what ISML can offer. Of course, we cannot say how much time it's going to take, but there is still a little bit of advantage ISML has for the upcoming couple of years, I guess.
Yeah, for sure. And of course, with the whole AI boom, it's not going to slow down anytime soon. I mean, just look at Elon, for example, purchasing all these like big ass fancy computers, quantum computing and everything, and you need loads of chips for that. And the the maker who makes those machines uh, happens to be ASML. So growth wise, in my humble opinion, I think there's still a lot of room for growth there.
Yeah.
And we can also see it for the average revenue growth, a healthy 18%.
Yep. I would
There,
also, yeah,
sorry.
I would also say, like, with regard to the net income growth and free cash flow growth, maybe we should have a look further down the road in our key ratios, because this one covers the whole eternity of, what was it, 20 years, I think we have in the
Yeah,
database. So I would say, yeah, minus 700% of free cash flow growth is probably not something what has been happening for the past few years. So we'll check it out later. Um, yeah, sorry, Robin.
no, but just yeah, I was about to mention that, and then we also look into how much debt they will have, and they are having, and they have been growing their dividends, but they have been diluting. But that's also over the whole 20 years. And if you also want to understand a bit more about that, is that ASML used to be part of another Dutch company called Philips, which is also known worldwide for especially medical supplies. They used to be together, and then they um, became their own entity, and that might also explain the share buybacks at one point. But I mean, we can check it out. Kirill, let's dive into the financial results and
yeah.
ratios and see what we can uncover
Yes.
there.
Yeah. The thing is, what you can see is growth is there. 27.5 billion, 28 billion, 30 billion for the past year. So it's you can see it's gradually going good. I would say in terms of percentages, we'll see later, of course, but as well as you can see, of course, their depreciation and amortization expenses rise, of course, hardware based, and R&D as well. So that's something what maybe you gotta be a little bit more careful about. So it's not something of a company that has just a well-established product that doesn't require too much maintenance. Now, in this case, you have to develop the product every year to stay to be in that monopolistic place where ISML is at the moment.
Exactly. But it will also be a better view if we can go to the percentages and ratios in a bit, because then we can see what the relationship is, because the it correlates with the revenue.
Yeah.
So you would also expect these kind of movements, right?
Yep.
For the shares outstanding, we see. I just quickly looking.
It's
We see
gradually
a big
going
jump.
down. Yeah, it's
Yeah.
gradually going down. So they've since 2012 they are buying buying them back. So something happened between 2011 and 2012 where they bumped it up and issued quite some stock. So
Maybe,
for you guys, something to check.
Yeah, exactly. Maybe acquisition of another company or entity or unit or something like that. But that's something, is like Real said, do your due diligence always. Like this video is just a starting point, right, of your journey.
Yep.
We don't give advice.
Yep.
Here I don't see anything. So the assets and liabilities.
Yeah, my concern is the liabilities are growing up as well. So you can see that the long-term debt is not really going down, starting from 2016. We'll of course check the debt burden itself in a moment, but could be a little bit cautious. On the other hand, you can see that it's only 4 billion we're talking about for 2024, and their free cash flow is 23. Sorry, that's free cash flow per share. So 9.3 billion is a free cash flow. So from 1 year, they can pay it out in a blink of an eye. To be honest, not a problem. I would say not a problem, unless they're gonna be piling up more debt for whatever reason.
Yeah, and if in your due diligence process, you can also see what the interest rates are on these long-term debt. So, for example, we see that also they acquired a lot of debt during COVID, where debt was actually cheap. So you can also check, so how much of an issue is it for 4 billion? Like, what are the rates and how much do they need to pay in interest yearly? And if you have a good overview on what it is, then may or may not be an issue. But given the timing of the second purchase of the debt, I think that they do quite a diligent job of looking for good deals. But of course, something that you need to check out. It's just an assumption.
Yep.
All right, Kirill. So let's go down and let's see the ratios.
Yep.
Yeah. So net earnings ratio steady.
28%, 27 for the past quite a few years, 4 or 5 years.
And this is really good. This is nice, right?
Yeah, R&D. Yeah, surprisingly, 28%, 27, no more than 30 for quite a few years. That's a good sign. So even though they still need to innovate a lot, it still doesn't take too much of their cash. I can also assume it could be considered as a threat on the other hand, because maybe it's even too good to be true. So it might just raise a question. Maybe they need to even spend a little bit of more money to create some even greater products to be even more, not available for any competition whatsoever. But that's all just a blah 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 from my side, to be honest.
Yeah, we don't know. Read the annual papers and you'll know.
Yes,
basically. Revenue growth. Yeah, I mean, it's stable. And it's also not really an issue when it's not growing as fast. We see it's not really declining. But, I mean, it is steady.
Well,
and as long...
I would say over the past... So the past 2 years have been rather low, right? So we're talking about 3% and 9% this year and previous year. I would say it's, of course, on a bit lower side. Before that, you had double-digit growth, even 30% at some point, which is crazy. Makes sense because COVID, everyone worked from home, more cheap demand and all of that stuff. But, yeah, so I would also assume not to expect too big of a growth eventually from ASML. So no more than, let's say, 10% a year, realistically speaking. Just if we're talking about the ASML stock valuation part of things.
Yep. Let's go down. Let's see. So net earnings ratio is in line with the revenue growth. Yeah, we've talked about the outstanding shares. So that's good. So they are buying back shares. They are emptying the pool of shares outstanding, which makes you money, and then they're also giving you a dividend, which is also adding shareholder value. So they're doing everything according to the book to at least make you as a shareholder happy.
Yeah, and also keep in mind that I would also say they're playing it strategically quite well, because in my books I'd rather spend more money on putting it into business and making it better. And from these 2 points, they're not also piling cash into share buybacks and dividend growth. So they still would understand, hopefully, that there are some better use to their cash, instead of just doing these kind of, I would say, shareholder manipulations, which are rather secondary. I would say, like, the companies that are at the point of full saturation, when it's like a huge cash cow kind of company, like, for example, Apple, there's not that many growth opportunities, right? So then in this case, you could bump up these 2 points quite heavily. But in case of ASML, there's still hopefully more growth opportunities. Maybe diversification, maybe some other machinery they could start supplying, or maybe making their own chips. So be competitor to NVIDIA, to AMD. Why not? Why not?
And also, I think before we go into the valuation, it might be a good time to check the 930 score of ASML.
Yes. We are having a B, so it's quite all right. And I think, as we discussed, the best parts are on the margins and return on investment capital. Makes sense. And then the stuff that is lagging a little bit behind is the P ratio, the revenue growth, free cash flow growth a little bit. Mainly, I think, because again, it takes the maximum numbers that we have in a database. So back in the days, ASML stock was also pretty heavy in terms of the overvalued territory. So from the historical perspective, I think it's also improving a little bit on the P ratio at least. I would say quite a solid, quite a good company. Not that many competitors yet. But then again, you have to consider this geopolitical risks and the new entrance threats from China. I would say these are probably the biggest things.
All right, Crew, let's go to the valuation.
Yes.
So we, of course, want to know whether or not ASML stock's price is justifiable, whether it's a good bargain, and that's what we do here. So here you can manipulate some kind of numbers in order to give a clear picture of the valuation. And mind you, of course, you can try this for free yourself. We'll show you in a bit how to do it. But key takeaway, if you have other ideas than that we have, go in, check it out for free, do your own calculations, and maybe jump on it or not. Anyways, Kirill, so free cash flow starting point, let's put that on last year, as we normally do. So here we also do it. We normally do this on the last year, but if it's negative, you get some weird calculation. So then we manipulate the free cash flow starting point sometimes. The projection periods, Kirill, I mean, do you think that ASML is going to go anywhere, or it's going to be beaten by China within, let's say, the next 5 years? I mean, it's a difficult market. There's a lot of turmoil. But if, for example, you also have to have the market, if you are a Chinese chip machine maker, to have a good market to sell these units to. So there's a lot of geopolitical ties at play here as well. So it's difficult. What would you expect?
Yeah, I think in this case we could, like, what's the beauty of 930 is that we could just say we don't know. There's going to be a bunch of risks, a bunch of problems that may be there ahead. We could simply just put the margin of safety in. We could just say, okay, we can put in, let's say, 30%, just to account for all of this. So we just want to make sure that, like, at least third of the price, we want a discount on that, just because of these things. And for the rest of the stuff, we can just even try to pretend that it's going to be the business as usual and business as it is, So we could say projection period, we usually put, 10 years, 7 years? Why not? It's not going to go out of business. It's not going to disappear. Otherwise, the whole probably Western world will disappear because it's the only supplier of this. Not going to happen. Not going to happen for sure.
All right, that's 10 years. Discount rate 10%. You can also play with this. We use knowledge from Warren Buffett to use a discount rate. But of course, you can always choose something of your own liking. The estimated growth rate, Valkyrie, let's see. So the past 3 years, they have been growing with an average of 3%. And you already mentioned they're not really going to grow more than 10% given the constraints that they have. However, there's of course there is going to be a big demand for chips and computers in the future, given the AI boom and how much money and resources we're throwing at that as well. So I would put it, if we take the average, I would bump it up to maybe 8%, 8-9%.
Sure.
It's still realistic. It could be higher, and if you as a viewer have some different opinions, then feel free to check it out yourself. For the PE ratio, so the average for the past 3 years has been 33. I think that's fair. Let's just do 33. We have the average of that, and then we'll calculate with that as well. Required return, because we are stock picking in this example, you are having a bit more risk on your hands. In ETFs and index funds, you normally get a return of between 7 and 10% yearly. Because you're stock picking, you want to have a bit more returns because you're taking on a bit more risk. So, let's put in 11-12%. And then hit the analyze button.
Ooh, I don't want to show it. No, I will show it. Yeah, kind of makes sense on one hand. We're talking about the average valuation of 480 euros with the current price of almost 660 at the moment. But again, the target valuation formula is the one which is dragging it all up. To be honest, I would say this would be a very good time to load up if it hits that price for sure. But then on the other hand, it's also just a question of, what are you looking for in that bet if you want to buy SML, right? If you really just want to load up pretty heavily on it, you can do that. Just wait. Just wait, put a notification, just wait for that price. On the other hand, for example, what I'm doing maybe a little bit something not according to the book, but I'm just trying to play out the kind of the waves, how the stock is going. So I'm just playing around, getting, let's say, I don't know, 10% here and there, just from the stock fluctuation, and how it's pretty much doing the the behavior of it is pretty easy to understand. So you can understand, okay, if it goes down, I don't know, let's say 10%, you can probably just load up on it a little bit. But yeah, overall, from the fundamental perspective, a little bit too expensive, as we just discussed. And if you want to be super cautious, then you can even just wait for more and wait till it hits 300 range. But I don't expect that to be like super realistic in the upcoming maybe year or something. I don't know what has to happen for it to crash, to be divided by 2 in the upcoming couple of months.
Yeah, you also have to think about, of course, is this is a monopoly that we're talking about. So you will have to pay some kind of, the stock might be worth on paper, the amount of money that we just calculated, right? But then that is in a vacuum, but you normally have use same calculations with other competitions, but the competitors here are none. So you will have to pay a premium for that as well. And then on the other side, we are not really read up on ASML's latest ventures, on how the business is performing. Like, for example, me, myself, I have no idea how their whole business works in detail. So that there could be some hidden gem that we are missing with our calculations. But if you know what they are, then you can also adjust your estimates based on that. But Kirill, I think there's only one other question that I need to ask, and that is, where can we find the web app?
Yes, and I shall provide you the answer. So you would go to 930.com. The link would be in the description and you can even get a deal. But I'm not going to show it to you guys because you're going to exploit it too much. As Robin mentioned earlier, you can check out the demo. You don't need even to sign up. Just have a look, browse around. If you want to check ASML stock or any other stocks that you're interested in, feel free. We're talking about super affordable pricing at the moment, but we're going to be changing our packages in a little while. and we're also going to be upgrading our platform. So if you would like to lock your pricing tier at the moment, you'd better do it now before it's too late. We're of course gonna also make the announcement when it's gonna happen. But yeah, if you're interested, if you're curious, stay with us. Let us know what kind of other company you wanna check out, and yeah, Rob.
But of course, thank you guys for watching. Thank you, Kirill, for your lovely insights. We're back. We will make videos again, and we'll see you guys in the next one. Hopefully, or probably, most definitely next week.